Hello and welcome. In this video, we will try to understand what a government should be doing in an economy which is in a slowdown or a recession, on account of a reduction in demand and consumption. We will try to understand why the supply side, or trickle-down solutions, are fatal in a recession, and why the governments continue to implement them. Let us start with a crash course on how economies work. In any society, people need resources to survive and enjoy life. To make this work, different people produce food, products, and offer services that they have expertise in. This is called division of labor and specialization. People in the society exchange these resources and services. These interactions are the substance of what forms economics. For transacting in these products and services, they use a commodity which is acceptable to others, and can be stored without losing its value. This medium of exchange, which could be a valuable metal, or a sovereign currency, is called money. Money is not itself consumed, but facilitates consumption of goods and services in an economy. Without money, people can only exchange goods or services, called barter. Barter is not an ideal system, because in barter system, people can do a transaction only when they can find someone who has the commodity or service that they need, and that person is also ready to accept what they have to offer in exchange. The working of money and effects of change in its supply, we will be discussing in a later video. What is important for us to understand for now is that all goods and services which have economic value get valued in terms of units of money. How do economies grow? As human societies become more sophisticated, they produce a greater and greater variety of goods and services, which can be exchanged. The total value of all the products and services being transacted in an economy, when expressed in terms of money, is the size of that economy. As the population and complexity, along with the speed and quantum of commercial interactions in a society grows, so does the size of its economy. When this mechanism is disturbed, the growth is adversely affected. There can be many reasons that can cause a break in the smooth working of the economy and its growth. In past, when human society was largely agrarian, natural factors like droughts, famines, floods, earthquakes, epidemics, etc., were a major source of economic stress. Even today, in more fragile economies, these factors can affect the ability of people to carry on normal lives and affect trade, commerce and social interactions and cause economic slowdowns. In modern context, these factors can be seen affecting global economy in form of climate change. In addition to natural causes, there can be man-made calamities, like wars, revolts, revolutions and insurgencies, which can also affect economic activities, and are known to cause economies to collapse. To operate normally, an economy depends a lot on systems and institutions, including a stable government and rule of law. Breakdown of rule of law and efficient working of institutions and systems also can be a reason for economic collapse. Economic or monetary sanctions and trade restrictions placed on countries also have major impact, as these lead to a shrinking of international trade. Ill-conceived social and economic policies, projects and programs can also lead to economic destabilization. And finally, economic mismanagement and the inability of governments and its institutions to identify potential sources of economic stress, and an incompetent and non-prudent response, when the economic crisis hits, are also reasons an economy can get into trouble. When an economy is in a slowdown or a recession, the governments and its institutions can resort to a range of tools at hand to respond, to get the economy out of the crisis. These tools or actions depend upon the economic philosophy which the government believes in. There are two approaches, when seen from a high level. The first approach consists of measures referred to as demand-side economics, while the second approach comprises measures categorized as supply-side economic measures. Demand-side stimulus is based on the idea that when an economic slowdown is on account of inability of the masses to have enough money to spend, ensuring that a large portion of people are provided enough money so that they can spend on essential items of mass consumption, will drive the demand for industrial output, agricultural produce, and services, setting in motion a cycle of consumption, higher production, capacity utilization, investment, and employment. This will lead back to increased income and consumption. The increased economic activity will also lead higher generation of taxes which the government can use for public expenditure. On the opposite side, the supply-side economics proposes to encourage the rich, called the wealth creators. This is done by reducing taxes, making regulations favorable, and facilitating supply of cheap money, with the hope that these wealth creators would use this increased wealth to expand businesses that would create jobs and promote economic activity and prosperity. This would eventually see a spillover, or trickle-down, of prosperity to the less privileged. Trickle-down is not an official theory of economics. It was merely a mocking reference to this supply-side approach of macroeconomics, which became popular after 1980s. The people before the second half of 20th century, more crudely, referred to this philosophy as the horse and sparrow theory. Now we need to understand the ways in which trickle-down economics is implemented. There are many measures of supply-side economics which are used by the governments to implement the trickle-down approach. These include reduction of taxes and duties on companies, and personal income tax, especially on the wealthy, or the ones in higher tax categories. Then, there can be reduction of taxes and duties on production, sales and exports. Another way could be by reducing of taxes on holding, and transfer of wealth, often referred to as capital gains tax, and taxes on inheritance of wealth. Benefit can also be given in for easing of regulatory barriers for setting up and expanding businesses, and relocation or shutting down businesses, including ease of declaring insolvency and bankruptcy. Then there can be formulation of such regulations that would make the position of workers and employees weaker. For example, reducing minimum wages, reducing employee protection and employee benefits, curtailing the ability of workers to form unions, making it easy to hire and fire workers and increasing of working hours. Businesses also benefit when regulations and reserve bank actions make it easier and quicker to give cheap loans, at easier terms, including free money, commonly referred to as a bailout. By making it easy to implement wealth concentration techniques like stock buybacks and distribution of dividend, and diluting regulation on formation of monopolies and cartels, and weakening of environment protection laws, also benefits the wealthy at the cost of public interest. Is supply-side economics all bad? Of course not. As one cannot use a sword where a scalpel is required, each of these two approaches we discussed work best when used under the right conditions, and with the right intentions. The supply-side approach works great when businesses are working on full capacity, and need funds to expand, at commercially viable cost. Supply-side measures can also be used to attract business to an underdeveloped area, or to level the playing field, when unreasonable regulations, or non-competitive tax regimes, make it difficult for the domestic industry to do business, as compared to their competitors abroad. Likewise, incentives are desirable when they are targeted towards innovation and encouragement of new entrepreneurs. Why is the implementation of supply-side approach bad in an economy that is in a slowdown, or in a recession? There are certain unique conditions in a slowing down economy, or one that is in a recession, that make supply-side or the trickle-down approach perform less than optimally, making it deliver less a bang for the buck, so to say. And sometimes, they can fail miserably, or worse, even exacerbate the economic slowdown. The first reason lies in the psychology of expenditure behavior of the rich and the poor. By definition, an economic slowdown is marked by an inability of a large mass of people to earn and spend, and thus, participate in the economy. A recession affects goods and services of mass consumption the most. When the rich people get money, it is not spent on daily mass consumption items, as the rich do not have a problem of day-to-day survival, to begin with. Any benefit given to them will be spent on high-value, but low-volume spending. On the other hand, when a large number of people living at subsistence level are given purchasing power, the money is immediately put in motion, as their needs are immediate and necessary and not whimsical, or impulsive. What they spend goes towards procuring goods and services of mass consumption, which kickstarts the economy on a large scale. The second reason why supply-side stimulus does not get fully applied to boosting the economy, lies in the logic of corporate behavior. To assume that the moment there is extra money in the hands of businesses, it will automatically result in passing on of these gains to the customer, in form of price reduction and discounts, is wrong. In an economic slowdown, businesses are also victims of low capacity utilization, resulting in lower recovery of costs, and therefore lower profits. Any gains from relief given by government, would first be applied by businesses, to recoup losses, shore up the earnings and improve profit indicators, so that they can boost value of their shares for enhancing shareholder worth. Extending this logic further, the idea that any incentive given will lead to fresh capital investment and boost demand for capital equipment and employment, is also proven to be a fallacy. Since an important characteristic of any economic recession, is underutilized production capacities on account of shortage of demand, any initial increase in demand will be used to maximize the utilization of existing production capacity, and thus will not spur new capital investment, in the near term. There is a negative side effect of applying measures which will encourage businesses to give price cuts. This results in customers getting into a habit of discounts and lower prices. This resets the customer perceptions and expectations about what they would be willing to pay for that product or service in future. They start holding back expenditure decisions, in anticipation of discounts and lowering of prices. This, coupled with cutthroat competition, in a slowdown, can drive down prices, and have a deflationary long-term impact, and a permanent fall in prices and sales turnovers of goods and services in the economy. In an economic recession, where on account of low tax collections, there is already a depletion of government funds, any concessions and tax breaks given to businesses, deplete government revenues even further. This inhibits the ability of governments to undertake projects that could potentially create public infrastructure, jobs, incomes, and jumpstart the economic activity. The most wide-reaching negative impact of demand-side approach comes in form of weakening of regulation. This is the most insidious consequence, because its ill effects cannot be measured easily in monetary terms. In the name of giving encouragement to businesses, to boost the economy, many of the regulations and controls put on businesses are removed. This results in far-reaching negative social impacts like growth of monopolies and cartels, compromising of consumer protection, environmental degradation, exploitation of workers, etc. Supply-side macroeconomic policies also lead to inflation and creation of asset bubbles. Cheap money, especially when targeted at specific forms of investments, like financial assets, or property, leads to an undue inflation in the prices of these assets, creating price bubbles, which are ticking bombs, which eventually burst and destroy the markets, asset values and the passive investors. It is often said that economic cycles of high growth and slowdown are an inevitable fact of economics. This is totally wrong. A well-managed economy under a watchful eye can keep ticking along nicely, when it is supported by money supply adjusted in tandem with the needs of the economic activity, carefully targeted incentives, and watchful regulation. Economic bubbles are, in fact, an evidence of the failure of truly free working of economy, and fair price discovery. Creation of bubbles and their eventual collapse create cycles of artificial boom, and eventual and inevitable bust. Supply-side measures, like reducing interest rates, discourage savings. Making credit cheaper, and lowering interest rates, fetches lesser and lesser return on income on savings. In a growing trend, central banks all over the world are driving the interest rates to negative. As a result, bank customers today are faced with an unimaginable reality of being charged by banks for money deposited, instead of getting interest income. This is how cheap or free money discourages capital creation by individuals. On account of pro-rich measures like cheap money, coupled with regulatory ease of exiting and liquidating businesses, and buying back shares, enterprises are incentivized to get out of business, and cash out. This in effect means, that what used to be communal wealth, employed in businesses and their operations, is slowly sucked out of the wider economy, and converted into personal wealth in the hands of the rich. This constricts economic capacities, investments, jobs, tax revenues and reduces the velocity of money, as value moves from productive form to unproductive assets like paintings, antiques, estates, jewelry, etc., promoting rentier capitalism. Finally, the paramount argument is a moral one. When one can use the same amount of money, to benefit a large number of people, who need it more, and are more likely to recycle it into the economy, why give it to a small number of privileged few, with the hope that it may eventually pay economic dividends? Crippling one segment of the economy, that comprises the largest chunk of humanity, for the benefit of few, is not just morally wrong, but also bad economics. Weakening labor protection leads to lower standards of living among the masses, reducing their ability to become economically effective and their motivation to be productive. There is greater income inequality and growing social discontent. Trickle-down philosophy measures are cruel to the elderly who live on fixed incomes, after a long contribution to the society, when their saving fetch less and less returns, and they get gouged by negative interest rates, even as free money increases their cost of living. When the rich get tax breaks and incentives, it reduces the money in the hands of governments, and makes them weaker, leading to lower investment in areas of public importance, like infrastructure, education, social security and culture. Famous philosopher and economist Adam Smith said, "It is not from the benevolence of the butcher, the brewer, or the baker that we expect our dinner, but from their regard to their own interest." Smith goes on to say, that a person needs to be led by an invisible hand, to promote an end, which was no part of his intention. This invisible hand is the hand of law and regulation, which should ensure that the rich do their part and pay their dues to the society. Given all these reasons, it would seem to be a no-brainer, that when you increase the ability of the masses to spend, everyone, the people, the businesses, and the governments, gains. If that is so, what then explains the governments in most countries continuing to implement policies which are not just morally wrong, but also economically disastrous? How do the rich and powerful continue to get the governments to implement policies so brazenly for their benefits, and get away with it? How is the idea that trickle-down economics works sold to the public, even when it is against their interests? A famous quote popularized by Mark Twain says, that there were three kinds of lies: lies, damned lies, and statistics. The apologists for the "greed is good" mantra use statistics to mislead. Firstly, they wrongly link economic growth indicators to trickle-down measures, even when there is no causal link. They hide the fact that the growth is on account of other causes. They also conceal instances where this correlation does not exist, and also the negative effects of trickle-down policies on the economy. The second misuse of statistics is in use of measures of prosperity used. Figures like GDP or per capita income do not reveal the fact that in these numbers, the real and disproportionately large growth happens in the wealth of the rich. The fact that the growing GDP or per capita income is not evenly and fairly distributed across all the constituents of the society. Even galloping economies have growing inequality, and a growing mass of people are pushed into ever-increasing poverty. Another example of misuse of statistics, out of context, are the employment numbers. Merely talking about a high percentage of people being employed camouflages many evils, like the compulsion to work on account of a lack of social security, in soul-shattering servility, in jobs one does not like, with dehumanizing work hours and working conditions, with stress of performance, low quality of social life, degradation of human relations, and the incalculable damage to many other factors that constitute decent human existence. The next factor that is responsible for governments continuing to implement pro-rich measures, at the cost of the masses, is the role of the group of people in society, that we can call the buffer class. In all societies, at all times in the history of human civilization, there has existed a buffer class of people, between the privileged and the deprived. In past these were the feudal lords or the landlords. In the modern world, the so-called middle class forms this buffer. This section of society is not elite, but also not among the poorest. This class of people are led to believe that they would benefit if the status quo remains. While this buffer class gets some benefits, they do not have very high aspirations to have too much and are happy to just be able to retain the relative comforts they possess. They are happy that they are better off as compared to the multitudes who are far worse off. Most in this class are conditioned to believe that thriving of the rich is the key to their own comfort, and therefore this class of people stand in support of pro-rich policies. The most influential agent in pushing the tools of trickle-down economics is the propaganda orchestra. This is a gaggle of voices that works in tandem to create an opaque cloud of noise. It works on the concept that a lie, repeated long and frequently enough, can create an illusion of truth. The first section of this ensemble is made up of the politicians who are beholden to industry for election funding. They use all their powers to convince the larger group of population that what they are doing is in the benefit of everybody. The second group of instruments of this orchestra are the professional lobbyists, international institutions, trade bodies, institutes and research foundations funded by business. These sponsor and carry out research, and produce reports with loads of data and analysis, which favor their theories. Then there are economists and experts, who have proven record of loyalty to the system. These experts are given a halo of respectability by giving them recognition, by mention of their names and work across media, and giving them awards and prizes. Later, these useful idiots pay back the system by lending academic credibility to the gospel of trickle-down philosophy. Finally, all this is tied neatly into a fancy package, through the use of all kinds of media platforms, which are also owned by the elite, where analysts and others we just talked about, repeat the propaganda loudly and constantly, and tell fables of philanthropy and the goodness in the heart of the rich and the big business. Complementing the factors pushing trickle-down philosophy that we discussed just now, there is also an all-pervasive effort to black out the competing point of view. The idea of mass demand generation, and all the arguments about how it is far superior and effective, both from the point of view of economic logic, and also morally, are obscured and crowded out in all kind of public discussion and on media. In the same way, numerous successful examples in the world, like in the Scandinavian and Northern European countries, where a social welfare state, with a strong culture of collective bargaining and unionization, high levels of prosperity, and a great quality of life exist, are not discussed widely, as viable models. Such cases are either not spoken of, or brushed off as impractical oddities. Economists and experts, who talk about these theories and economic models, are suppressed, denied access to popular platforms and discredited as radicals or oddballs. Even the most brilliant argument becomes ineffective, if it is neither allowed to be talked about, nor be heard. And this is how a logically flawed, and morally corrupt economic model continues to operate, and be propagated by a small, but powerful, and well-coordinated group of players, with a wide influence and an extensive control over the resources of this world. Their work is made easier, on account of the ignorance and apathy of the ill-informed masses, who are indifferent of their own rights, and unaware of their true powers. their powers to demand, and obtain, a fair, and duly deserved share, in the riches of this world, and their right, to a civilized human existence. The greatest injustices to the masses of humanity, have, as much been on account of, the ruthlessness of tyrants, as on account of the people's own inability, to recognize their self-worth, and to live, and die for it. The content of this video is based on the blog post, The Reasons Why the Trickle-Down Approach is a Grievously Injurious Remedy for Recession, from the blog, Reading Between the Lie. For a more detailed reading, you can yourself check out the blog post, by clicking the link shown here, or given in the video description. Thank you for watching. We hope you enjoyed the video. If you liked it, please give us a thumbs up, by clicking the like button. If you think someone else you know would enjoy watching it, click the share button to share this video with them. To see more videos from us, subscribe to our channel, by clicking the subscribe button, and then click the bell icon, to get notified, whenever we post a new video. In case you want us to make a video on a topic you feel would be of interest to you, or want to give us your feedback and suggestions, please let us know in the section for comments below. Until later, have a great day.